Good afternoon and a warm welcome to the Colliers webinar. For those who do not know me, my name is Rosso and I head up the industrial logistics team for Colliers in the UK. Today we've got quite a lot to get through, but I thought I'd just start reflecting a little bit on 2020. While we had many challenges in 2020, I feel there were some positive things at the end of the year. Firstly, a Brexit deal was concluded, which I think is fantastic for the economic stability of the country. A vaccine has been brought forward and now been rolling out. And finally, the take-up and the year for the logistics sector was stellar. Whilst it was not immune, it was very robust. Today in our agenda, we'll follow the introductions, sector analysis and outlook, panel discussion, and Q&A. Paul Norman of CoStar will be moderating, and I will hand over to Paul now to introduce the panelists.
Hi all, thanks Len. My name's Paul Norman, I'm Managing Editor of CoStar News. Thank you very much to Colliers for asking me to moderate the first of their industrial and logistics events this year. They're always a fascinating update on a market that's clearly been enjoying quite a long purple patch and thriving in many areas during the pandemic. So just a couple of the running order points. Firstly, Andrea Ferranti, Head of Industrial and Logistics Research, is going to provide a recap on Q4 2020 activity and present the latest market trends. And then I'm going to open up discussions with a great panel of industry experts. Throughout this, we're going to have live polling, which will take the pulse of the audience, which is made up of a lot of industry professionals, and we'll reflect on some of their answers with the panel. And the results of that poll will also be forwarded to you afterwards. But before Andrea gets going, I'm quickly going to introduce our panel too. So we have Ian Henderson, who is Group Property Director of Wincanton. Ian's been with Wincanton for 9 years, having previously been Head of Property at BAA, B&Q and Sainsbury's. As Group Property Director for Wincanton, Ian's responsible for managing the property portfolio across the UK and Ireland, comprising around 6 million square foot and 200 plus sites. Next, we have Paul Hanley, partner at exciting new launch, Bridge Developments. Paul is responsible for Bridge's acquisition and development activities throughout the UK. It's focused on core supply constrained last mile logistics submarkets, which have a high barrier of entry and where demand exceeds supply, both from a capital and user perspective. They opened their first office in November 2020, so it'd be great to ask Paul about doing that in this market. Prior to that, he worked for Prologis across the UK and the US. We also have Tom Edson, Head of Retail Capital Markets at Colliers International, who is a real UK supermarket specialist. It's going to be great to talk to him about retail and industrial and the synergies between the two. And then, of course, we have the home team, who you'll know very well, Andrea, who's Head of Industrial Logistics and Research, and Len, who is the Head of Industrial and Logistics, who you just heard for. So I'm going to hand over now to Andrea to present to us first.
Thank you very much, Paul, and hi everyone. Before we delve into the latest stats and trends and commentary, just like to highlight this. Please go and visit us, our social media channels, YouTube channels, to get the latest updates on the market and to stay up to date with us. So without any further ado, let's move on to the first slide. So this slide is quite indicative. I like to present it. You all know there's been a strong increase in online commerce due to the pandemic. But the most interesting stuff here is how these numbers are actually reflecting, indicating what was been happening in terms of infection rates. So I'm not going to dwell too much on this, but just want to highlight what we saw in May with a record share of 33%. And in November, this actually exceeded 35%. December is going to be elevated, we believe, of course, because of the Christmas trading and some localized restrictions. In January, of course, we are currently in a strict lockdown, so we don't expect this share to decrease with regards to total retail sales in the UK. If you look at the monthly average since January 2020, this is around 27%. So we moved from 19% in 2019 to around 27%. And we expect the overall annual share of online sales to reach around 30% this year, because of course of the extra volume of trading that we saw over the past couple of months and all the lead up to Christmas. On this note, I'd like to ask Len's opinion, if I may, with regards to where you see online sales ending up in 2021, or when we go back to some sort of normality. Len, please.
Thank you, Andrea. I think absolutely, if you look at it, the structural change has been amazing, really. You've had 7 years growth in 9 months. Where do we see it going in 2021? My personal view is it will continue on the same vein it has been. Maybe not at the same growth rate, which was pretty stellar for 2020. But there are some challenges with online sales, which all the occupiers and people involved in the supply chain will know, which is the returns. Obviously, click and collect and those type of initiatives are having a big help. And it'll be interesting to hear from my colleague, Tom Edson, on the retail side later, with how the retail is combating on the high street. But structurally, we think it's happened, the change. We don't think it will reverse. We believe it will continue going forward, the increase online sales. We think 2021 will be in excess of 30% for year-on sales at the end of 2021. Thanks, Andrea.
Thank you very much, Len. So this actually leads us to the next slide, where we actually included some infographics because we always talk about data charts, bar charts and everything. So what we're seeing here, we've been discussing for several years now the shift from a linear model in terms of supply chain and in-store fulfillment, and of course towards a centric model. The pandemic has definitely accelerated that. The consumer is at the center, and the gap between, of course, the click or the online order and the fulfillment is actually shortening. This has seen an increase in investment in automation and mechanization, although this is quite expensive, so only certain occupiers have been able to do so, those ones who are more financially sound or global. Of course, this has had an impact onto high street and retail, as mentioned just by Len. And then again, we'll have Tom from our retail capital markets who will be able to tell us a little bit more what's happening on that front. But the key thing here is how the change of the store, how retailers will trying to compete with online sales, trying to capture more footfall. This, of course, is going to be leveraged by increase of technologies. But this perhaps we'll be able to discuss this a little bit more during our panel discussion if this topic arises. So if we move on to actual take-up activity here, Len mentioned it's been a stellar year. The figures are backing what he's just saying. So 2020, we saw 48 million square foot of take-up for large distribution warehouses, 100,000 square foot plus. I know that some of you are interested in last mile, multi-let. We're going to be able to look at some of the key stats, particularly from the rental front, later on during our presentation. Then we'll have a chance to discuss this during our Q&A session. In terms of take-up activity by type of unit, here we're seeing a split between second-hand, new, and actually the share of spec space being taken up as a proportion of total space. So new supply, which comprises, new take-up, which comprises spec space plus design and build, is actually grown dramatically. We're seeing a strong growth. However, the design and build section actually comprised of a 20 or 50% overall take-up here, again reflecting the low supply environment that the sector is actually confronting at the moment. We're seeing pure play guys and of course third-party logistic provider extremely acquisitive. In terms of the proportion, I mean, pure play occupiers, online occupiers accounted for 31% of total take-up in 2020. Third-party logistic provider, I'm sure they've been extremely busy in 2020, accounting for 28.5% of total take-up. A retailer around 15-17%. So there's a quite broad-based demand, but of course, third-party logistic provider have actually increased the take-up activity in terms of nominal square footage taken by twice as much of what we saw in 2019. Then again here, 2021 is going to be difficult to predict. There might be a partial slowdown because if we compare to 2020, which is a stellar year, that might be understandable. But where you see activity going, particularly over the next few months in 2021.
Thanks, Andrea. As Andrea said, 2020 was a stellar year. If you look at the 48 million square feet, even if you strip out the Amazon factor, as we call it, that would still allow for a record year if you stripped out their 30% of the market share. I think the other really good dynamic is if you look at that's broadly 30 million square feet in the supply and the take up was circa 50, that shows if you do the comparison, you'd only have between 6 to 8 months of supply available on the current take up. Of course, last year was a stellar year, which means the likelihood it's not going to be that this year. But the platform is set again, I believe, for another great year of take up. Of course, there's going to be some bumps in the road. We've got some challenges. A lot of companies are struggling, but there's still quite a few or a larger number of companies doing well. In the round, I think 2021 is going to be a solid year. And my bet would be it would be more in line with the 5-year average, which is a circa just below 30 million square feet. Thanks, Andrea.
Thank you very much, Len. So you mentioned about supply. So I got a slide here, which is showing the new deliveries in the UK market, again, for large distribution warehouses under 1,000 square foot plus. So as a current supply standing stock, we got 32.5 million square feet of space available. This is a contraction of 6.5% year on year. And however, we've seen developers providing nearly 24 million square feet of space since January 2018. Supply has remained in check, which is extraordinary. So in 2020, we saw about 8 million square feet delivered. 2021, we've been tracking the latest announcements, the new schemes which are currently either under construction or ready to start. At the moment, we're expecting around 8 million square feet of new space being delivered by the end of December. However, don't quote me on that because, of course, there are going to be potentially more announcements during the year, and some schemes might end up completing by December 2021 or 2022. What we're seeing here, we're seeing a good level of a new supply coming through and strong demand with supply in check, which is astonishing. This leads us to our next slide here. So what we're seeing here, I'm not going to dwell much on this chart because it's quite busy and long, but I just wanted to highlight this fact that you're probably aware of this because what we're seeing over the past few months. So here you're seeing rental dynamics versus CPI, and of course you can pinpoint the major economic contraction there. So post 2008, and then between 2011 and the beginning of 2012, when there was the European sovereign debt crisis, we're seeing rents contracting, which would make sense. It took them about 8-9 years to recover to the levels seen pre-global financial crisis. But we haven't seen that in 2020. Of course, rental growth has slowed down, which is completely understandable because it was coming off from recent high when we reached nearly double-digit rental growth at the end of 2016. London and South East, of course, outperforming. Standard industrials, more multi-let estates, close in urban area, seeing good rental growth. The closer you are to a large population area, the stronger rental growth is. This is a strong correlation factor. Distribution warehouses have been seeing some good growth. We're actually going to look at that onto the next slide, where we're going to be seeing the latest data from MSCI, again, MSCI Digest. These are monthly data. And of course, the December data will be available in next week or the next few days. So it will be interesting to see where December is going to end up in terms of equivalent rental value growth from the MSCI. But the key thing that I want to mention here is the acceleration of rental growth that we saw in November. So across the different subsegments, we're seeing nearly doubling. I mean, 0.4 rental growth for November for standard industrial. This is for the whole UK. So in that sample, you get some secondary stock or some institutional stock in a secondary location. So again, it's showing that rents is growing where some small businesses are struggling from a financial point of view because of the lockdown measures. London, of course, outperforming and growing half as much of what we saw over the past 3 months. Distribution warehouses, of course, not showing as much growth as we saw for the other subsegments. But then again, here is more of a technical issue because, of course, distribution warehouses, we're looking at all stock, I mean, secondary stock or prime stock in secondary location and vice versa at a national level. So, of course, you're going to be seeing more, I mean, stronger growth for single leg distribution warehouses in key markets, particularly around at M25, Southeast, but we're seeing strong growth in the Northwest, Yorkshire, and the Midlands. Every region, some good growth. So that leads us nicely to the next slide here. So how's capital market behaving here? Of course, there is a lot of liquidity available. Central banks have been financing us more or less, and there's been a lot of government intervention. So there is not a liquidity crunch in the sector. But on the other hand, there is this money needs to be channeled somewhere. As some sectors have been not performing so well, and also it's difficult to get the return at the level that some annuity fund and some funds and investor needs. So we saw in Q4 2020, we saw a record Q4 in terms of investment activity, more than 3.6 billion done in just 3 months, the end of December, where we were talking about strict lockdown and some shops were closed. We are actually ending up above 8 billion pounds for 2020. And we might actually adjust a little bit higher as we finalize the latest Q4 deals, which are still being analyzed. So this is fantastic, but the key stats here, which is not really shown, was actually the overall share with regards to total investment volume. So industrial investment accounted for 19% overall investment volume, which is a record share never seen since investment volumes have been recorded. So if we look at then at the next slide where we go the yield profile here. Of course, I'm not going to discuss much these trends here because then I look forward to the panel discussion. But this one is quite indicative. So we're seeing actually yields compressing during the pandemic for the industrial sector. We are potentially going to be seeing yields equaling what we saw in December 2018, where we got to a historical level. So yields might continue to compress, particularly with a strong investor appetite for industrial assets. Other sectors, of course, have been a little bit more affected by the pandemic and the occupational slowdown due to working from home, etc. But I'm not going to talk much more on this, and we can actually look at this yields dynamic during our panel discussion. So on this note, I'd like to hand you over to Paul again for our panel discussion. Thank you very much.
Thank you, Andrea. As I say, we've got a hard stop here at 3 o'clock as we now go into the panel debate, and we will also be looking for questions from the audience. So, and what we'll do is if we can't get to all of them, try and come back on them afterwards as well. I think to set the scene, I wonder if we could have one of our first polls just to gauge some audience response here. So following a record year for the industrial sector in 2020, will a drop in consumer confidence affect take-up activity? Likely, unlikely, undecided. Just give you a couple of minutes on that. And I wonder if we could see the results so far on that. So unlikely that it's going to affect take-up activity, which sounds fair enough. Now we've already heard Len talk about his kind of predictions for take-up, but I thought this all comes into a question to ask our panel. I mean, how long can this boom time continue for industrial? And what are we seeing already in 2021 in terms of take-up and investment activity? Now, I thought I'd come to Paul first there, being as he's right at the cusp of a new company launching into this space. I mean, how long can this great purple patch for industrial carry on?
Thanks, Paul. To be honest with you, I probably wouldn't want to put a time frame on it yet. I think from our perspective, we hope it'll continue for the foreseeable. You know, markets obviously are are cyclical, and at some point it will end. But we're certainly not seeing any signs of that at the moment. And certainly from where we're sitting, you know, only just under 2 weeks into January, the market really has sort of picked up right where it left off at the end of December. Activity seems very, very strong. You know, we're already hearing of deals being done. We're already seeing a lot of opportunities come across our desk as well. So certainly, the sentiment from the agents and from other people that we talk to in the market is very bullish, and you know, I consider that it'll stay that way throughout the rest of the year.
Okay, and Ian as well, you're obviously incredibly busy at the moment, I would presume. Is there any sort of things to change that for you?
Hi Paul, hi everyone. I think what may happen through this year may become more measured, because obviously in amongst those stats are COVID related requirements, which are obviously extremely urgent and needed quick turnaround. So I do wonder, with that hopefully tailing off, suddenly it will become more measured in approach. And I think what might also happen, Paul, is I think all the 3PLs are thinking about this, is how do they build resilience into the supply chain? So, you know, in terms of the obviously important, you know, immediate requirements, but what do we have to put together for the sort of medium to long-term future, whether that's campus style, whether that's repurposing of buildings. So I think there will be a lot more around sort of that thought process around what do we need to take for the resilience we need.
Okay, and that's so a lot of work at the moment going into the kind of the future buildings that you're going to require as well.
Correct. Yeah, and the thing with us is obviously all our customers are different, all of their requirements are different. So, you know, we have to respond to those requirements, and that always makes it interesting, because we just, you know, there is no one particular theme through the requirements. They're all completely different. So, you know, we manage about 200 sites, and I think the way through this is better collaboration with our customers, collaboration with developers and landlords to get them, you know, just understanding the world we're working in.
Okay. Now, coming quickly to Len and Andrea in particular, I mean, what are we seeing at the beginning of the year? I mean, Len, you've given us a brief look at that, but it'd be really interesting to get a sort of, you know, sense of activity now already.
Hi, Paul. Thanks. So far, the year started off immensely busy. You know, we're finding a lot of our occupier requirements are pushing us to get on out there and look at some of the requirements we have for them. Not only ourselves, speaking to some of the competitors, they've started the year on a busy note. Obviously, we finished the year on a high. But I think going forward, I suppose, how long will it go on for? I'm quite optimistic that the logistics revolution, call it, will continue for the foreseeable future. I think there's a lot of dynamics with it. The rents are still, you know, reasonably affordable compared to some other sectors, and the online e-commerce is obviously driving it forward. And actually, it's a very simple asset class, which I think a lot of the investors quite like as well. But high-level summary: start the year very busy, and I think, you know, 2021 will be another sort of stellar year. I don't think it will eclipse or overtake what happened last year, but I still think it'll be a very solid year.
Okay. Sorry, Andrea. Yes. Sorry.
Yeah, no, sorry, Paul. I just wanted to add that, of course, Paul Henley mentioned that market as cyclical, which makes perfect sense. And we had extraordinary activity in 2020, and so it might be difficult to replicate that. But we expect take-up activity to be in line with the 5-year average, as mentioned. But one thing to watch is how supply chain investments will continue this year, while we're expecting consumer demand to slow down, because of course now we will see consumers struggling a little bit more potentially than what we saw in 2020. But what keeps me positive is that, of course, supply chain is to continue to invest, because they're not efficient enough to reach the end consumer in an efficient manner. Some are not efficient enough.
Okay, thanks, Andrea. Well, I wonder if we could go back to another poll again, because I think that's going to just get the audience's sense of this as well. So how long can the boom times continue for industrial? End of Q1, end of H1, into 2021 and beyond, or undecided? Let's see if we can put some timescales on this. And I wonder what the answer is. Well, there we are. It's going to keep going and going and going. I think there's not much people disputing that. So I want to come on to something now, which probably we could bring Tom into firstly on, which is, prime industrial rents continue to increase. Will 2021 see more out-of-town retail sites being purchased for industrial hybrid use? And I suppose that just is that whole question about how long that can continue, this trend for the synergies between retail and industrial, and people buying sites in retail to turn into industrial. And I wonder, Tom, you could speak a bit about that for us.
Yeah, quick answer is, sorry, good afternoon, everybody. My initial response will be actually limited at the moment. Now, the reason is, I appreciate the British media has a certain angle on retail at the moment, but we need to take into mind that not all retail is bad. It's long been said there's about 25 to 30% too much retail, and that retail is the retail which is frankly broken. There is still a strong place for good retail, whether that be high street shopping centres or retail parks. But actually, on your question, Paul, will we see more? We will definitely see some repurposing. We've seen a little bit so far, not very much. We do still have the disparity. It financially doesn't work still for the rents you can potentially receive on a retail park against the rents on industrial logistic, even when you think about the lower yields that you will get in the logistics arena. The other factor, which I think will take a bit longer to run through, is that most good retail parks are the only particular part of the retail sector which will be suitable for this arena. And where those parks would be good for logistics, they're generally still good trading retail assets, predominantly in quite strong cities, London being the obvious, but even the likes of Manchester. So we're still finding that the actual tenants themselves are trading relatively well, so there won't be an immediate reason to vacate. And the rents still in the upper 20s and early 30 pounds per square foot, even at yields at 7.5%, it still won't work. The other part which would need to be addressed for conversion to logistics is that when you obviously are in urban areas for that format, it's not just the logistics platform that which is hungry for space. You've also got residential and you've got PRS. So it's not just it's singular as a poor retail park when there's other alternatives away from logistics. Okay, and I wonder, maybe come to Paul quickly here and ask, are you looking at this opportunity as well as part of your, drive to build the business across the UK?
It's certainly something we'll consider. I mean, we wouldn't build a business off the back of it. I think what Tom said is absolutely right. There's a pretty significant disconnect between just in the economics with regards to cap rates that are moving out on retail units, but far higher rents than you would see for industrial. So it's very, very difficult to buy a retail warehouse at a basis that supports redevelopment for industrial. It just is tough. It's a lovely idea, and I think that probably most people who are involved with industrial property, if you're driving down A Road and you've seen an old Toys R Us or something, you think, that would be great as a conversion. But in reality, it's much tougher to do from an economic perspective, and also from just the functionality of the building. They typically don't have the clear heights. The floor slab hasn't been designed or built to the same specification that a warehouse would do. You know, it may only have one dock door or no dock doors and just one level access. So that there's a lot around the functionality. You know, the yards are very tight, but there are huge car parks. So you know, and you need you need the inverse for that for industrial. So it is tough. That there will be opportunities, you know, without a doubt. There are a couple of high profile ones last year, like the old Toys R Us building in Croydon, for example, that Amazon took. But yeah, I think that there'll be, it feels for the moment anyway, like those deals will be more sort of outliers. They won't become the norm unless retail values, you know, slip that much further.
Okay, I just wondered if anyone else on the panel feels strongly about this. That's not quite right. I mean, it seems quite a clear answer there from both Tom and Paul, but don't know if anybody else wants to jump in.
I think the only thing, it's interesting, it's more around the, you know, with retail parks, and it's a conversation we very much want to be part of, is, you know, what does that mix ultimately need to look like? And it isn't necessarily about a retail park failing. It could be about, you know, stepping back and saying, right, how do we split this retail park? What are the mixes that need to be in there, for want of a better phrase, to future proof it? And whether that's in town centres, you know, whether it's on a, you know, out of town retail park, it's ultimately, what is it going to look like? What is that mix of use? Is it, you know, a parcel delivering for those customers that are on that park? You know, is it a, you know, a click and collect? Is it a showroom which you then go to the website? And I think in these very difficult times, you know, that is what we should all be thinking about, in terms of, we're calling it repurposing, but is that true collaboration? Because to do it, you're going to need the planners, you're going to need the landlords, you're going to need our customers, and you're going to need people like us.
And is that happening at the moment, Ian? Or is there more, you know, that sense of collaboration? Are you feeling that's happening, or does there need to be more education? Or
it's coming there, it's getting there, Paul, and you can sort of feel that the sort of you know, there are certain landlords who absolutely want to be in the room to have that discussion. You can feel there's an impetus. I'm on sort of the rates panel for the CBI, and you can see there's a push there to say, how can you get rid of some of these roadblocks for use of space? And because ultimately, you know, it's about maximising the use of space, getting the most out of the space that is there. So definitely those conversations are beginning.
Okay, now sort of this brings us around to another question, which is all to do with supply, and obviously we're hearing this huge demand. And the question is, can the people feel confident that supply, and really interesting lens, sort of talking about a 30 million square foot of a supply at the moment, can supply be delivered fast enough to support the ongoing e-commerce related demand? And will we see more spec development this year? I guess I've come to Ian first there on that.
I mean, it's an interesting one. I think what will be interesting is what comes back this year, in terms of, that's the slight unknown in terms of second-hand space that comes back. I think we're not seeing that spec development that you would necessarily expect, in line with all the excitement around the take up for this year. So I think there's a question there. And even if it does begin to ramp up massively, you know, there's a lag in that. So there's a slight concern there. But I think it is also about the second-hand space that is out there, and, you know, the use of our space, the use of our customers' space. So it isn't just about speculative development. If you go back to my original point about, you know, all the customers' requirements are different, absolutely some of them will be fulfilled by spec, and it needs to be high, and we'll probably talk about that later around e-com and what it needs to be and building in that resilience. But also there are a lot of requirements that need second-hand space, and inevitably they will need it very quickly. They can't wait, you know, 9-12 months for it.
Yeah. Okay, I'm going to guess come to Paul here as well. I mean, this supply question, I mean, do you think it's there, and can you does there need to be speculative development? Is that something you're interested in? Just to ask you about it.
Yeah, absolutely. Yeah, to be clear, at Bridge, we wholeheartedly believe in spec development. That's going to be a real fundamental driver for us going forward. The way that we see it is pretty simple. When you're in an environment where rents are growing, cat rates are compressing, record numbers of take up are being achieved. The average supply across the UK is only 6 to 8 months. That's your market sending you some very, very clear signals around what you should be doing as a developer from our perspective, and that's building on a speculative basis. All the indicators are suggesting that the market can withstand that. So for us, we're very, very focused on, as you said at the top of my intro, on supply constrained infill markets. So for us, markets that are very, very close to the high density areas and pockets of consumption, we're seeing that there's a huge demand there, and that demand and supply imbalance, we don't see that changing. And the way in which you solve into that is by building spec.
Okay, and Tom, I guess I'd ask you as well. Is there that e-commerce demand that you're looking at from the retail sector? Is it going to be able to be met?
Probably not. I mean, this is where the two sectors are entwined. I think lots of how it will adapt will be down to, again, our occupiers, our retailers. They know they need to meet more of a retail demand, and the one part they can do it via the conventional logistical method. But the evolution may find, certainly in the out of town market, we see more and more hybrid stores coming to light. What once would have been a traditional 15, 20,000 square foot retail shop, you may only find half of that unit is used for a retail showroom per se, and the back half is used for last mile urban logistics. So that's a way that they could start to fulfill that kind of the E requirement. For the retailers themselves, which ultimately drive lots of the demand for logistics, as it was alluded to earlier, they do have this serious problem of returns, and it really does hit their margins. So again, dealing with the online side, if they can go with that hybrid format, and this is pure me blue sky thinking, you may find that obviously they can encourage clients more and more to use click and collect and click and return, which therefore is more cost effective to obviously the occupier. The other part which we haven't really touched on, certainly again for the retailer themselves, is that the consumer is aware that they will buy 4 or 5 items and often return them. There is more of an awareness of the economic and the environmental impact on that. And actually, I've dug this out on purpose. There was a stat in, I think, the FT the other week that in America, the equivalent online returns could fill 6,700 jumbo jets. And they said the majority of that would go into landfill. So there is other questions that has to be answered around the benefits of that form of purchasing. It's not going to go away, but it has to be made more efficient, because ultimately that ends up being out of the retailer's margin, which is why that hybrid model may be one way to part address that.
Well, one question is, who counted that up? Who got in the jumbo jets, I guess? But
somebody with too much time.
And just coming to Len and Andrea, would you like to pick up on that as well, from the kind of, what are you thinking in terms of actually meeting that demand?
I think the spec which is coming out is probably not quite sufficient to meet the demand, which in turn creates and continues to give a very good supply and demand dynamic. I think obviously if the market was flooded with spec, I remember in 2007 after the financial meltdown, in some areas of the country you had 10-year supply available. So I think everyone's conscious of not flooding the market again, over flooding the market. But I would say, from an occupier's perspective, we act sort of, 40% of our work is from occupiers and 60% is from landlords and developers. So we're generally on both sides of the coin, and we're very sympathetic to obviously the occupier demand at the moment, where there is generally undersupply of good quality and second-hand buildings coming through, which means actually when the occupiers are looking, there's big demand, which means the rents are being pushed up, lease terms are, but that's just the nature of a market which is moving forward and continues to improve. So I suppose the reality is probably not quite enough spec. But, you know, people are trying to bring it forward as quickly as they can, as Paul will, I'm sure, tell you, dealing with planners, government agencies. You know, this is not a stroll in the park stuff. It can take years sometimes to bring a site forward, which should be quite straightforward. So I believe the developers and the funds are doing what they can, but just with the constraints of planning, etc., things aren't coming forward as quickly as one would hope.
Okay. All right. Well, now we haven't actually looked quite yet at the investment side of this in too much depth. So I think we'll bring up another poll here quickly while we look at that. So prime industrial yields are close to or at historical lows. In 2021, are you expecting yields to compress, move out, remain unchanged, or are you undecided? And yeah, we'll just see quickly before I ask the panelists about this, what the audience thinks. So they're going to remain unchanged. Some people also think they can get a bit tighter. Well, I suppose here I'd come to yeah, Andrea. Quickly ask, I mean, what you're seeing at the moment? Do you think you know, things are going to get steamier, or is that, you know, sort of say about the same? Does that sound right to you?
Yeah, Paul, yeah, it really, I mean, we are already seeing some strong demand for industrial assets, and prime yields in certain locations are sub 4%, approaching 3% or sub 3%. It depends, of course, on the equivalent rent on those schemes around M25 in London. But yeah, there is strong demand for prime single let as well. Some units are being marketed as sub 4% in the regions. They're achieving 4%. We're seeing strong demand. And then again, if you look at in terms of relativity of what's going on in the other sectors or in the wider financial markets, I mean, there is money there in terms of relativity. Some central banks, as I mentioned before, they're talking about negative rates. And you could get a mortgage in Denmark, I think, at a negative rate. So it's difficult for investors to create returns. We are already at very low level compared to historical standards, but we're not in the same frame of reference anymore. So we might see some further mild yield compression over the next few months, if not the whole 2021. It really depends on how the other sector will perform, because of course some investors are investing across all sectors. So we might see, of course, PRS or hotels or another sector coming back in, performing really well in beginning of 2022 or something. So you might see some reallocation there. But at the moment, the industrial sector is set to see a further mild yield compression, in my view.
Okay, Paul, you're obviously looking to buy at the moment. What are your calculations telling you, and how easy is it to get into this sector as well, I guess, is the other
yeah, it's not easy for sure. Yeah, there are very, very high barriers to entry, and you know, if you want to invest into this market, you know, it's incumbent on you to have done your homework and really understand the drivers of that particular sub-market that you're investing into. You wouldn't want to go into it blindly. You need to have done a lot of research, and a lot of that intelligence is built up over many years and working in those markets to really understand how they perform. From an occupational perspective, that's what you ultimately need to understand. If you're buying an industrial building as an investment, you're making a bet fundamentally on the lettability of that product and also its potential for rents to grow. Certainly, in terms of the question, we do not think that yields are going to move out at all. I'm completely with Andrea. I think there'll be more compression. The compression is driven fundamentally by the weight of capital that's seeking to get into this market. So the competition for investors to place capital into industrial property drives those values to record highs as we've seen. And then also people's view on rental growth. So in very, very uber core Greater London markets in and around Park Royal along the A40, we've seen net initial yields dip below 3%. Some getting down closer to sort of 2 3/4. That's very, very aggressive as a net initial yield. But if you're building in rental growth assumptions that are in line with how that market's performed over the last 2 to 3 years, then yeah, your reversion looks sensible. And I think that's how you'll see people price these assets now. People accept that those in-place rents are low. There's going to be growth, so people start to look on it on an equivalent or reversion basis. So the net initial yields, while they seem pretty eye-watering, whenever I see that, you realise that there's a real rental growth story that's sort of embedded in that sub-market that's coming. Okay, and Ian, obviously you're covenant critical in some of these prices. How do you see it playing out this year?
I'd agree with Andrea. I mean, the only note of caution is that these are extraordinary times. This is not the new normal. We don't know what the normal is going to look like yet. And it is fascinating. Some things we will rush back to, and the moment we're let out again, we will rush out to them and we will want to do them again. And other things we will have learned to live without. And I defy anybody to absolutely confirm which, we can live without and which we will rush back to, because I can't tell. So, but I think that will then dictate how it begins to play out across the next year or two. You'll always need the engine room, which are the legit, are the buildings. It is the engine room. The supply chain is absolutely vital. But, what it ultimately looks like, I don't think anybody has, none of us know at this point.
I'm going to say pubs and the golf course people are going to be rushing back to from my end. But anyway, so sorry.
Travel for me.
Travel, yeah, there we go. So one thing, Ian, you've already brought up, and I'd love to ask all of the panel about this, because you've mentioned this is extraordinary times and what's the world going to look like, and you're obviously thinking a lot about this at the moment. What does the industrial property of the future need to look like? What's it got to take on board?
I think it's really interesting, because I think if you're talking about sort of e-com, it's obviously higher. You're up to the sort of 30 meters, more scope, better loading. I think it's flexibility around the building. Ultimately, and if I was the owner of that building, I would want flexibility. Again, the resilience word is that the ability to flex the building, the ability to put in floors, to put in automation. But we talk about sustainability, but sustainability is also about you don't want to waste space. You don't want to waste space in that building. How do you get the most out of it? I think people will be absolutely key. Location, from a staffing perspective, will be key. And I think it's just, we have lots of, we've taken on 3 buildings last year, and it's just the speed of being able to get the information. So simple things like as-built drawings, just that, so 10 years down the road, you have access to those drawings and they're updated. Maybe there's more duct work under the surface so that you can build up the power 3-4 years down the line. Maybe it's landscaping on the borders instead of hard surfaces so that you can easily access it to put in duct work. So there's a multitude of things, but it is just ensuring that you can move quickly to adapt.
Okay, I'd like to come to Tom here as well. I mean, I know you've got your sort of grocery sector webinar coming up very soon, but I just wonder what you think the buildings of the future need to look like.
From our, well, I alluded to it earlier. I mean, I'm going to talk about retail, but certainly, yeah, that hybrid model, I think we'll see more prevalence. Good plug for our grocery seminar webinar coming up, because I actually say to people, if you want to look at how to do multi-use buildings, the supermarkets, the big 4, are actually the ones leading the way. Yeah. Go back to the days, which I'm sure you remember, when very large supermarkets were being built, 130, 40,000 square foot. Obviously, that was no longer fit for purpose. And what Tesco and Sainsbury's, etc., have done, have now repositioned those for doing online fulfillment. And ironically, if you want to pick off a nice 8-acre site in an urban location for that fulfillment, well, it's already there. Urban fulfillment is called a supermarket. You've got customers coming to your door now in much smaller conventional footplates that the public will see, but then also dropping in, like I say, that online in-store fulfillment piece. We also need to be mindful that we're seeing more and more fascias come into those supermarket space. So, we saw Sainsbury's, obviously, with Argos, announced that they were going to close a number of stores, bring them into the actual supermarkets. That was a direct correlation of the pandemic, and fast forwarded the business plan by 4 to 5 years as customer habits changed, and you can start to use these buildings in different ways. So yeah, I think that trend is what we'll see more of, multi-use space. The emphasis, as I keep going back to, is it has to be in quite large retail warehousing type formats. Your high streets and your shopping centres, ultimately, some will die, some will be repositioned. There will be a place for some of them, but they're just not suited for this seminars kind of audience.
And that multi-use space, Paul, is interesting because people forget there is a bit of a two-tier market. Of course, you will get the online retailer who will take 20 years, put down roots, and they can take the 2 million square foot, but then 60% of the take up last year are not online retailers. It is about multi-occupied is 3PLs, and 3PLs are 3 5-year contracts. So it is very much two types of market, and I think it's designing for that 3PL market. And I think there is also an onus on us, because I can see potentially those contracts lengthening, whether they will or not, but I think they almost have to create more of a partnership between 3PLs and customers, because I think, again, is that you want to build in the resilience and the collaboration, and you do that by having a longer relationship. But I think around that multi-use, that then reinforces the flexibility of the building.
Is there evidence of that happening at the moment? Those sort of longer term leases?
Longer term contracts.
Sorry, yeah.
It depends on sector. It depends very much, but it hasn't changed a lot. Pretty much what it was 8-9 years ago is pretty similar now, and I think that's just a legacy thing. And the interesting thing is, as I always say, the lease length is often dictated by the contract, not by how long that customer wants to stay in that building, which again can get lost in the negotiations.
Okay, and just to come to Paul as well on that, I mean, are you looking at the sort of how the building's evolving? What are you particularly looking at in that sense in industrial?
Yeah, absolutely, and I agree with what the other guys have said around the flexibility, and also if you're future proofing for the potential these buildings may one day be served by autonomous vehicles, or more automation needed to be brought in in the here and now, having a greater provision for electric vehicle charging and things like that. But I think probably more important than that, for what will the building in the future, what will that look like, is probably actually more of a greater focus on the employees that work inside it, and their well-being, and how the building can be designed to reflect that some thought has gone into that. How do these buildings make people feel is a huge point, and that's something that employers are more aware of now than ever. And also just how the building sits within the community that it's located within, and how well it integrates from a multitude of factors, from public transport links and things like that, but also other things that the building has around it in terms of amenities and walking routes and things like that. That's really, really important now, and we're seeing that customers and tenants are looking at those sorts of attributes as well. Employee retention is huge, and if you can try and solve some of those issues, when you're selecting your building, longer term, that just builds better resilience for your workforce.
Okay. Thank you very much. Well, I see we've got about 6 minutes left here, so I wanted to come to the elephant in the room, perhaps. Len mentioned it at the top, but we've not gone back to it at all since. So just quickly to try and look at, now that an agreement's been struck with the EU, or an initial one, what does that mean for supply chains, reshoring, and investment? Does the panel think? I might maybe come to you first, Len, there, just to ask you what it all means.
Thanks, Paul. I think the first thing to say is obviously, firstly, it's going to create some problems for the supply chain with goods coming in and going out. I think what will happen is that there will be people taking slightly more space to store things for a longer period, so they don't have to have so many runs for their supply chain to bring in the food or whatever their product is. So I think for the UK, I think it's going to be reasonably positive. I do think there will be some issues because of supply chains, goods coming in and out. But I think in the round, I think we'll overcome those. And I think the high level summary I would envisage is a little bit more space being taken across the piece to deal with additional storage of products which need to be dealt with. I think companies as well, they'll need to obviously refine their supply chains. But I think in the round, a little bit more space taken, a few bumps in the road with dealing with it coming in and out. But I don't think it's going to be bad news generally for the UK.
Okay, thank you. Then that's good news. Paul, is there anything you'd like to say about how you think it's going to impact things this year?
Yeah, I agree with Len, really. I don't feel particularly bearish on Brexit, and I never have really. I mean, I think that, you know, the UK accepts it as a given, really, that we can't produce all the things that we depend on other countries to produce. They can't all be done here. So, you know, there'll be an element of just what Len said. People either have to carry, you know, more stock to reflect the fact that perhaps there's going to be longer lead-in times now to bring things into the country. And yeah, maybe it'll actually help, you know, the manufacturing sector if there are elements where, you know, bringing it in just takes longer. You know, all of a sudden think maybe things will get produced here. You know, for us, you know, our focus is less about where things are made and more about where they're consumed. That's our big focus. And, you know, we know that Brexit isn't going to change, you know, high density areas, high population areas where people have got money in their pockets. That's where the consumption is going to sit. And that's what's important for us from an industrial real estate perspective is still having those facilities that can service that need at the end of the cycle of that product's journey.
Okay, and I'll come to Andrea as well quickly to ask about that. I mean, one question, it is going to be some uncertainty in this period. I guess there needs to be some more flexibility built into discussions for a while. Is that the way to see it? And just ask really what you see happening.
Yeah, no, Paul, I mean, we've seen already. I mean, if we're talking about the lease structure, leasing terms. Okay, so what we've seen from the statistic, I mean, everyone has been witnessing that there's been more collaboration between occupiers and developers, trying to, of course, to manage this crisis, which was derived from the pandemic. We've seen shorter lease terms being agreed to the tune of 12 months. Rolling break, 1 month rolling break, 5 years term, 3 years term. Some occupiers taking, of course, secondary space, which was available at very, very short terms. But on the other hand, it comes down to demand and supply. And if you have a strong building, if you have a good building in a strong market area with good rental, good prospects, it might be difficult for a developer to let it on a 5-year terms. We're increasingly seeing some developers being much more open to provide a 5-year break, while before was 5 years or 10 years ago was unthinkable. So the collaboration is increasing, but of course it really depends on the stock and the market dynamics and the location with the demand coming through from different occupiers.
Okay, thanks, Andrea. No, I think I'm really close to the end, so I'm going to. Well, collaboration seems to be the word I've picked up a lot today, so that's obviously the way forward. I'm going to pass back to Len now, and thank you so much for having me. And really interesting panel, so thanks very much for that.
Thanks, Paul, and a big thank you to our panelists for hosting today on the panel, and Paul for moderating. Greatly appreciated, and thanks a lot. All the best.